Hello and welcome to Options in Plain English. Today we're going to be talking about the differences between trading options and trading stocks. This lesson is going to be especially important for those coming over from the stock trading world into the world of option trading. To begin with, we look at ownership. Stocks represent ownership in a corporation or a fund, if we're talking about an ETF, whereas options are simply contracts to potentially buy or sell the underlying at a predefined price and before or on a certain date. So stocks represent ownership in something, so in a corporation or in a fund, and an option contract, options represent just a contract that exists between a buyer and a seller. So those contracts do not represent ownership of anything, just a contract. Voting rights, because options don't have ownership of anything, they don't have any voting rights whatsoever. In the case of stocks, if you have stock, your voting rights are proportional to the number of shares that you have based on the capital structure of the corporation. Options expire. Stocks do not expire. That's a big difference right there. If you're holding stock, you can be holding stock forever, theoretically. And there's stockholders out there that have been shareholders for 20 years, 30 years. So you can maintain perpetual ownership of stocks, whereas options, because of how they're designed, have expiration dates. In terms of the number of shares or contracts outstanding, stocks have a limited number of outstanding shares, and only the ones that are part of the float or floating stock can be traded in the market. So what this means is when there's a corporation or an ETF as well, there's a finite number, there's a limited number of shares that are created, that exist, and out of those, only the ones that are considered as part of the float or a floating stock can be traded in the market. So those are the same shares that are changing hands in the market. Whereas for options, they don't exist. They get created as they are needed. So if there's a buyer and there's a seller and they agree on a price for a call or a put, then that particular option is created, regardless of whether it existed before or not. So the potential number of options is unlimited. When it comes to dividends, options don't receive or pay out any kind of dividend whatsoever. Stocks, if you're long a stock before the ex-dividend date, you're going to receive a dividend. And if you're short a stock prior to an ex-dividend date, you're going to be paying out that dividend. So stocks deal with dividends in the form of a cash stream, and options do not. However, the way options are priced, consider a dividend stream as part of their price. When it comes to trading units, in the case of stocks, you can trade as few as one share of stock, so they trade in shares individually, whereas options trade in option contracts, one option contract representing 100 shares of stock. When we talk about bid-ask spread and liquidity in general, stocks and options have different levels of liquidity. Let's start with stocks. Stocks are extremely liquid. The bid-ask spread could represent much less than 0.01% of the stock price. For example, and this is an example that I just looked up just right now, Apple, the Apple stock, the bid-ask spread is 3 cents when it's trading at $310. So it represents a 0.0001% of the price. So 1/10,000th of a percent of the stock price. Options, on the other hand, are liquid when we talk about widely traded underlyings or options. The bid-ask spread fluctuates between 0.5% and 5% of the option price. In reality, it's actually sometimes higher than 5%. So those are the ones that are not very liquid, and we don't even consider those in our trading. But the ones that we trade usually fluctuate between 0.5% and 5% of the option price. So as an example, the June 2020 Apple 320 call has a bid-ask spread of 15 cents when it's trading at $14. So this represents a 1.07% of the option price. So as you can see, the options are less liquid than stocks. However, they are liquid enough that they can be traded, but you have to be more careful about what kind of underlyings you focus on, because bid-ask spread is much wider than on stocks. Leverage. Options are highly leveraged. You can get when we talk about notional amounts, you can take up to 10 to 1 leverage for long. If you for example trade long options, you can get up to 10 to 1 leverage, depending on many factors, but it's a highly leveraged vehicle. Whereas stocks have a 1-to-1 leverage. Every share of stock that you buy behaves 1-to-1 with the stock price, or moves 1-to-1 with the stock price. And if you're using margin, then you can get probably a 2-to-1 leverage ratio. But in terms of the product itself, it doesn't have leverage at all. When it comes to max loss, we talk about stocks, and this is something that many traders are not aware of, or they are aware of theoretically, but they don't really consider this when they decide to trade stocks, and when they see their investment as a solid, sound, and very safe investment. With stocks, you can lose your whole investment. If you're long stocks, your stock can go to zero. And if you're short stocks, it's even worse, because your exposure is unlimited, so you can lose much more money than you put in originally in your investment. So these are what I would consider not necessarily safe investments or safe vehicles. However, people or traders think that they are. When it comes to options, if you are going to be using long options, calls or puts, your exposure is limited to the premium that you paid. And if you decide to use short options, then your exposure is unlimited. However, if you use short options in combination with long options on the same underlying and for the same expiration, for example, you can start creating spreads where you have, to a certain degree, the advantages of options without having the drawback of being exposed in an unlimited way. Is there a way to profit from non-movement in a stock price? With options, yes, there is. And any short premium strategy takes advantage of this very fact. When you talk about stocks, if your stock doesn't move and you're long or short, then there's no way for you to make money, other than if there is something else like a dividend. But even then, when you receive a dividend, usually the price of the stock goes down by that same amount. So it's net, it's the same result. So can you profit from non-movement in a stock price? With options, yes. And with stocks, you cannot. What are the factors that influence the profit and loss for options and stocks? For stocks, I just mentioned, it's just the stock price and whether there's a dividend or not. But again, dividends, the pricing of the stocks take this into account. And for the most part, when there is a dividend about to be paid out or paid out on that date, on X dividend date, the price of the stock is going to go down by that amount. With options, it's a little bit different, because now you have several dimensions. Now you have the stock price and the strike price and the time to expiration and volatility and dividends and interest rates, and all of those factors come into play when you talk about the pricing of an option, whether it's a call or a put. So there's many more factors influencing your profit and loss, and because of this, you also have much more flexibility. So flexibility with options is high because you have, again, several dimensions. For example, direction, volatility, time. So all of those factors are changing and they are combining to create profits and losses if you decide to trade options. In the case of stocks, you can only bet on direction. So if you're long a stock, you make money when it goes up. And if you're short a stock, you make money when it goes down. There is no accounting for any other factor whatsoever. Because of this, options are definitely much more flexible than stocks. When it comes to trading hours, stocks trade from Monday to Friday from 9:30 to 4, so from 9:30 a.m. to 4 p.m. And some stocks or ETFs trade until 4:15, so 15 minutes after. And the big difference with options is extended hours. So with stocks, there is after hours trading and also pre-market trading. So from 4 p.m. to 8 p.m. in aftermarket, in after hours, and from 4 a.m. to 9:30 a.m. in pre-market. With options is the same thing. However, there is no extended hours at all with options. So it's only from 9:30 a.m. to 4 p.m. Some stocks or ETFs have options that trade until 4:15 p.m., but there is no extended hours whatsoever for options. Transaction costs for stocks are very low, especially if you consider the amount of money that you are moving, that you are buying with or selling with. And when it comes to options, the costs are relative to stocks still high, but they've started coming down recently. So when you compare them one-to-one, options versus stocks, options have higher transaction costs. If we talk about indices, with stocks, you cannot buy the index directly. You have to buy an ETF. So for example, if you want to buy the SPX, you cannot go and buy SPX. You have to buy an ETF that replicates what the index does. And that would be, in this case, SPY. In the case of options, they do have the possibility of trading indices, because you have options on indices where you don't get a deliverable for the index, but they are cash settled. So you can still trade the index by buying calls, buying puts, selling calls, selling puts. And that is a possibility that you cannot do with stocks. When we talk about margin, stocks, you can use for long and short options, you can use margin, typically 2-to-1. And with options, in terms of long options, the ones you buy, you cannot use margin. And with short options, the margin, you need it because it's used as collateral, but you don't actually use the margin itself. They have to be paid in full. Now, in terms of protection, what kind of protection do you have for stocks? Well, you have none. If you are long a stock and then the stock violently moves to the downside, then you're going to lose money. What you can do is you can put on a stop loss order, but then you are depending on the order execution. And typically when there's a violent move to the downside, those orders are not exactly the most efficient ones. So you would have to go with a stop loss market order, and then you get really, really bad executions. Or you can use a limit stop loss order, in which case you have the risk of not being executed at all. In the case of options, they can be used for protection. You can actually use the options for protection, and this protection is going to be dynamic. So once you have it on, you don't depend on execution. You are completely protected. So for example, you can use long puts to protect a long stock position. So if there is a crash, that long put is going to increase in value, and you don't need to do anything. Once you have it on, then it's protecting you all the time. So that's an advantage, and that's something that you cannot replicate with stock. In the case of long calls, they can be used to protect a short stock position. So if you put on a short stock position and you are worried that it might go really, really high, then you can have a long call protecting you, so that once the price gets there, your call is going to grow one to one with the price, and is going to be protecting your short stock position, which is going to be losing money at that point. Again, doesn't depend on execution. Once you have it, it's protecting you all the time, and it's a really a source of protection, and a type of protection that cannot be replicated with stocks. And finally, most traders like to trade on the long side, so like to trade with an outlook that is bullish in nature. But if you want to take on some bearish positions, if you want to do it with stock, you have to sell stock short. And selling stock short is not as straightforward as buying stock. When it comes to selling stock, you have to, for example, you have to have a process called locate, which means that before you sell something short, your broker has to locate the stock, get it from someone who is long the stock, and then it's going to allow you to sell it short. So this is a process that takes some time, and it's not as straightforward. Also, there is over time this rule has been taken off and then put back on again. But there is an uptick rule, which means that you can only sell stock short when the stock price is on an uptick. So it's going up, at least for that tick. So it's an additional rule that you don't have to go through when you want to buy stock. Also, some of the stocks, for various reasons, at different points in their over time, might become hard to borrow or none to borrow. So that means is those are going to have additional fees associated with shorting them. So it's not as straightforward as buying stock. When it comes to options, it's an easy way. It's just as easy to be bearish as it is to be bullish. Because if you want to be bullish, for example, you can buy a call. If you want to be bearish, you can just buy a put. Or, on the other hand, if you want to be bearish, but you want to sell premium and you want to get some credit while you wait for that move to happen, then you can be short a call, for example. So with options, it's very simple to establish bearish position. Whereas with stock, it's because of the mechanics of establishing the position, this is not as straightforward. There's a certain number of steps that you have to go through before you can actually sell something short. So I hope that this was a good summary of the differences between trading options and trading stocks. In our case, we're going to do both. We as traders are going to be having the advantage of combining and trading them as standalone products, but also combining them so that you can have strategies that do exactly what you think the market will do with a high degree of flexibility. And once you combine them, you can get the best out of all these products. So this is the advantage that you're going to get as an option trader, and that we are going to be learning as we go forward with our lessons.